Most Americans believe that saving money is the key to getting rich. You work hard, you put some cash aside, and one day you'll be wealthy. But here is a reality check that might sting a little. Just saving money will never make you rich. In fact, if you're saving money the way most people do, you're probably just wasting your time and losing a race you don't even know you're in. Your money isn't growing, it's slowly shrinking. Today, I am going to break down why your current savings strategy is failing and show you exactly what to do instead to build real, lasting wealth. This isn't about get-rich-quick schemes, it's about making your money work for you, so you don't have to work forever. Let's start with the most common mistake I see. People diligently save a portion of their paycheck and stash it in a regular savings account at their bank. It feels responsible, right? You see the balance go up and you feel secure. But here's the problem with that. First, traditional savings accounts pay almost nothing in interest. We're talking less than 1%, often closer to 0.01%. Your $10,000 might earn you a few bucks over an entire year. It's practically useless. But the bigger, more sinister problem is inflation. Inflation is the silent thief that makes everything more expensive over time. The coffee that cost $3 last year costs $3.50 now. That's inflation at work. While the official numbers hover around to 3% per year, the real-world cost of living often feels like it's rising even faster. So, if your money in the bank is earning less than 1%, but the cost of everything is going up by 3% or more, what's actually happening? Your money is losing purchasing power every single day. You're saving, but in real terms, your wealth is shrinking. You're pedaling a stationary bike, going nowhere, while everyone else is moving forward. This is what I call the savings trap. It feels safe, but it's a guaranteed way to lose financial ground over time. Now, don't get me wrong. I'm not saying saving money is a bad thing. Saving is the foundation. It's the essential first step. The mistake isn't the act of saving. It's the belief that saving alone is the end goal. It's not. Saving is just stockpiling ammunition. Investing is actually firing it at your financial goals. Wealth isn't built by hoarding cash. It's built when your money starts working for you, earning more money while you sleep. Think about it. Assets beat cash every single time in the long run. The wealthy understand this. They don't just let their money sit in a low-yield account. They use their savings to buy assets, things that generate income or appreciate in value. They stop being passive savers and become active wealth builders. Your goal should be to transform from someone who just collects dollars to someone who collects assets that produce more dollars. So, how do you do that? Where should your money actually go? It's not about putting everything on red at the casino. It's about a smart, diversified strategy. Here's a simple framework I recommend for splitting up your savings to put them to work. First, you need an emergency fund. This is your non-negotiable financial safety net. This should cover 3 to 6 months of your essential living expenses. This is the money that keeps you afloat if you lose your job or face an unexpected medical bill. And this is the only portion of your savings that should be kept in a relatively liquid, safe place. But please, not in a standard savings account. Put it in a high-yield savings account. These are online banks that offer significantly better interest rates, often 20, 30, or even 40 times higher than traditional banks. This way, even your safety net is working a little bit harder for you and helping to fight off inflation. Next, we have your investments for growth. This is where the real wealth building happens. Once your emergency fund is covered, any additional savings should be channeled here. We're talking about things like ETFs or exchange-traded funds and index funds. These are fantastic for beginners because they give you instant diversification. Instead of trying to pick one winning stock, you're buying a small piece of hundreds or even thousands of the biggest companies in the market, like the S&P 500. You're betting on the entire economy to grow over time, which has been a very good bet historically. If you're a bit more comfortable, you can also look into blue-chip stocks, stable, well-established companies with a long history of growth. The key here is long-term thinking. We're not day trading, we're investing for the next 10, 20, 30 years. Then, there's a smaller portion for what we can call alternative assets. This is where you can take on a bit more risk for potentially higher returns. This could include things like REITs or real estate investment trusts, which allow you to invest in a portfolio of properties without having to buy a building yourself. You could also explore micro-investing platforms that let you buy fractional shares of stocks or even a very small, calculated exposure to cryptocurrencies if you have a high risk tolerance. This part of your portfolio should be small, maybe 5% of your total investment, because it's more speculative. The goal of this three-part strategy is to make sure your money never just sits idle. Some of it protects you, but the majority of it should be actively growing. Now, let's talk about the biggest mistakes people make that keep them stuck. The most common one, as we've discussed, is just keeping all their savings in a checking or low-yield savings account. It's like keeping a star athlete on the bench for the entire game. Another huge mistake is what I call savings justification. This is when you save money on a purchase like buying something on sale, and then use that saved money to justify another impulse buy. You didn't actually save anything, you just redirected your spending. True saving is when the money is set aside and put to work, not just reallocated to another purchase. And finally, a massive error is chasing short-term trends. You hear about a hot stock on the news, you jump in, it crashes and you sell at a loss. This is gambling, not investing. Wealth is built through consistent, disciplined, long-term growth, not by trying to time the market or chase the latest fad. The single biggest mistake of all is simply letting your money sit idle while inflation quietly eats it for lunch every single day. So, what do the wealthy do differently? It's simpler than you think. First, they automate everything. They don't rely on willpower to save and invest. They set up automatic transfers from their paycheck directly into their high-yield savings and investment accounts. The money is put to work before they even have a chance to spend it. It becomes a habit, like brushing your teeth. Second, they prioritize assets over cash. When they get a bonus or a raise, their first thought isn't what can I buy? It's what asset can I buy with this? They see money not as something to be stored, but as a tool to generate more money. For them, savings is just the starting line, not the finish line. The race is about accumulating assets that work for them around the clock. Ready to make a change? Here are the exact action steps you can take starting today. First, open a high-yield savings account. Do a quick search online, compare the rates, and move your emergency fund there immediately. It takes about 15 minutes. Second, set up an investment account with a low-cost brokerage. Then, automate your contributions. Decide on a percentage of your income, say 10 or 15%, and have it automatically transferred and invested into a broad market index fund every single payday. Third, track your growth. Once a month, just log in and see how your investments are doing. Don't panic if the market is down. That just means you're buying more shares at a discount. The key is to stay consistent. Fourth, whenever your investments pay out dividends or you have gains, reinvest them. This is the power of compounding, where your earnings start generating their own earnings. It's the magic that turns small, consistent investments into a fortune over time. And finally, a crucial step, avoid lifestyle creep. When you get a raise, don't immediately upgrade your car or your apartment. Instead, increase the amount you're automatically investing. Don't let your expenses rise with your income. If you follow these steps consistently, month after month, year after year, your savings will do more than just protect you. They will actively grow your wealth and pave your path to financial freedom. So, let's wrap this up. Saving money alone is not enough. Stop letting your hard-earned cash sit idle in an account where it's losing value. Start investing, start building assets, and start making your money work for you. That is the real secret to building wealth. If this video opened your eyes and you're ready to learn more practical, step-by-step financial strategies, make sure you subscribe. We're all about giving you the knowledge you need to achieve real financial freedom. Thanks for watching, and I'll see you in the next video.